Hey,
Hello, Kuda.
I had to look up the link to join. How you doing?
Well, I think I fully recovered from my Sunday night debacle, crying, pounding my fist on the table.
With what?
My
Your Bears or? Oh, I'm sorry. You're Green Bay, right?
Green Bay. Oh man,
Yeah, yeah. Well, um, what could you say? The Detroit wanted it more.
they did, they did, and the reality is, Green Bay's not that good a team. Uh,
No, no. I mean,
you
they had it there. All they had to do was win, and that's obviously easier said than done. Hey, at least you're not a Browns fan, so.
know. Well, welcome back. I'm glad to see you made it out of Florida.
Yeah, yeah. You gotta love the airlines. When everything goes well, flying is a nuisance, and when it doesn't, it's miserable.
The airlines are interesting. I look at the world through the lens of a commodity trader, and air travel is a commodity, full up or straight up. Oh, you there?
Yeah, can you hear me?
Oh, I'm sorry. Yeah, I'm sorry. You know what? It started playing on my phone here. Got to turn this down. But air travel is a commodity, just like anything else. And one of the things about the lumber market that surprised me, and I think surprised you probably over the last 24 months or whatever, was the inelasticity of demand. I'm sorry, of supply. Inelasticity of supply. With those high prices, we expected more supply to come on to the market, and it just didn't. And I think that's what we're seeing in air travel right now. There's no doubt the demand has come back, but it's like the airlines are going, we know better this time. And they just haven't added the capacity.
I think a lot of that rolls back to labor issues, and that it's this is what we'd like to do versus the reality of what we can do. And you saw that firsthand with Southwest, and that they just didn't have the labor to replace flight crews, whether it was the pilots or flight attendants, and it just snowballed out of control. Where again, we've got some labor slides here. I figured today would be a good day since this is the first official show that I'm back anyway for this year. We'll kind of recap. I've got some good recap of 2022. A little bit of housing stuff, and obviously we'll talk about lumber. But that I think that's one of the big issues is that there's still a shortage of labor out there right now, and we'll kind of reference that. Um, Sorry about that. I thought I had my phone on call forward, but so let's
Let's kick it
jump
off.
in here.
January 10th.
Um, yeah, January 10th, and I don't know if there's anything that really jumps out here outside of lumber. The black line continues to decline. Interest rates have peaked for the time being. And then when you look at kind of a recap of last year, S&P for the year was down 20%. Um, and when you look at, I thought this was a great, this is from Josh Brown. He's on CNBC. But when you look at S&P calendar returns from 1928 to 20, this is through 28 through last year. It's common for Wall Streeters to predict an average stock return of 8 to 10% going into the new year. This is unlikely to happen. And you look at this is just insane. From 1928 to 22, 70% of all years have seen double-digit gains or losses, including 2022. So the reality is there's a 70% chance equities are going to be up or down double digits. So last year was a rough year, obviously down 20%. And then, when we talk about the traditional, 60-40% portfolio, 60% in equities. If equities are down, you get the benefit of treasuries. And if you were in just a Bloomberg aggregate global bond index, you got your, handed to you. Bonds were aggregate bond index is down 16%. So that 60-40% portfolio just got annihilated in 2022. You lost money on treasuries with the reset higher. You lost money on equities and everything in between. And so, the one thing that I'm stressing to my book of business, my clientele, is you don't fight the Fed. And we learned that the hard way when initially the pandemic happened and you had this big infusion of free money into the economy, and the Fed actually started to buy securities. And look at S&P PE. This is also basically a good S&P chart as well. But look what the Fed is doing here. They're liquidating their securities. And then when you look at central banks, this includes the Euro, Bank of Japan, just a combination of central banks, same kind of thing here where total assets, they're in liquidation mode of their assets. And this is not beneficial to equities, So the idea that we keep trying to pick bottoms in equities and the idea of a soft landing, life's okay if you can just get around the other side of or get to the other side of the street, until the Fed really pivots away from their existing policy of annihilation of inflation. The Fed is telling you that they do not want to see asset classes rally, and that includes equities. So, just bear that in mind. Don't fight the Fed. And when you go back to this chart, the Fed is in liquidation mode of their securities held, and they're going to be hell bent on the destruction of assets because they want to annihilate inflation. That's what the Fed has been telling you, and they're not mincing their words in telling people this. So, when you go into here's US dollar, the big beneficiary so far, obviously copper, gold, wheat and crude oil, lumber, obviously just stumbling around. And so when we look at overall investments in 2022, obviously US energy stocks, energies were really the belle of the ball here. And when you look at what got annihilated here, here you go, European stocks, US bonds. Here's your diversified 60-40% portfolio down 17%, US stocks down 18%, Chinese stocks down 21%, 30-year treasury down 22%. Remember, bond prices move inversely to yields. And so when we shift into commodities, year-to-date losers in commodities, well, unfortunately, lumber was numero here down 67%. Even gold, even though gold's been up on a tear as of late, gold was still unchanged for the year. So they're really outside of energies, and energies, even though they held on to these gains, a lot of this was given back into the back half of the year, where really they're, outside of moving into treasuries, if you were smart enough to buy 2-year, 5-year, 1-year type treasuries, and yield a 3.5-4%, there really wasn't a safe haven outside of just going to cash last year. There's nothing that stands out that would have been an obvious investment. If you would have, we would have had this conversation a year ago, Mike. Pretty much anywhere you put your money outside of energy would have gotten annihilated in 2022.
And I mean, energy, honestly, is a function of the Ukraine war more than anything.
Yeah, no, it exposed.
I mean, that was a black.
Yeah.
That's a response to a black swan event. So
Yeah.
I think here's my big prediction for 2023. When we're sitting here on January 10th of 2024, energy stocks are going to be the ones that got pounded this year.
It's going to be interesting because usually black swans are associated with a negative event. My black swan to watch in 2023 will be China, and they're getting pounded right now with COVID and dealing with that. But the reality is, they've pressured their economy so much that you dare I say you've had a people's revolt in China. But the reality is, China's had to open back up, and COVID be damned. And so as they start to come out of that, it'll be interesting to see where, I think the first half of 2023, or at least Q1, is going to be a difficult quarter from an investment standpoint. But as you get to the back half of 2023, or at least into the middle, China's the one to watch. Where do you get a resurgence of China as they come back online economically? If they're truly going to open up and attempt to fire at all cylinders from an economic standpoint, I think that's my black swan in a positive way, which could ultimately lead to green shoots just about everywhere from a commodity standpoint,
Yep.
just from a consumption standpoint. If China comes back online, that's something positive to watch down the road.
Unequivocal. I like that thought process.
And so here, commodities. This should actually, sorry, let me go back. This should say 2022, but this is 2022 year-end performance. Again, lumber was the leader of the losers here. You can see NASDAQ down 32%, 30-year bond down 22%, S&P down 18%, and then the winners, orange juice, heating oil. Volatility was a big winner. And so this will be interesting to see how this plays out. And maybe this bodes well for lumber in that it got annihilated in 2022. So maybe that ultimately bodes well for kind of recouping some of these losses in 2023. If you look at year-to-date return, so this is year-to-date 2023, high-grade copper's a big winner. You look at gold's up about 3%. Even the mini Dow's up 1.27%. And then you look at the losers, thankfully lumber's not on this list. And you look at energy, we're down 6-7% in crude oil, RBOB. And a lot of this has to do with crude oil, especially now, the fact that China's dealing with COVID, fears of COVID and just a global recession as China kind of learns to deal with COVID here. We look at treasuries, 10-year. I think the last time we looked at this, we were at 3.55%. We're 3.61, so no significant change here. Where you are seeing,
if we go back to that chart real quick.
Yep. Oops, sorry. Yep.
Classic technical analysis on this though is the trend has stopped.
Yeah.
The trend to higher. You've got a lower high, lower lows, and then you make a pullback. We headed back towards 4% late December, and it didn't happen. So, this is sideways. Is probably the best predictor right now, unless we take out that low from early December, which was down in the 3.4% range.
Yeah, and I think part of the argument on both sides with treasuries is, well, this is a signal we're done going up. The Fed's kind of reaching their zenith, reaching their Fed, kind of terminal Fed funds rate. But when you look at Fed meeting minutes from last week, they unequivocally said, don't assume just because we stop raising rates that there's going to be a pivot off of our policy, where every single Fed governor said last week they see no chance of a rate reduction in 2023. Again, I think the mindset with the Fed right now is we're going to get to where we want to go, and then we're going to want to see consecutive months, and consecutive being 6 months to 12 months of data to support the fact that we've done what we wanted to do with inflation. So just because you stop going higher doesn't mean you ultimately have to pivot and go lower. I think that pivot and go substantially lower with rates is going to have to be reflected in Fed policy, and actions speak louder than words. And so far with their actions and their words, there's no deviation from what they're trying to do right now. And but in trying to, from what this ultimately was, and we bumped up against the 7.5 to 7.75% on a 30-year mortgage. You can see a 30-year fixed VA is down at 6.5%, FHA 6.48, the 30-year fixed. And again, if you have a higher credit score, you're probably down in that 6.75. So you have seen a decent pullback off the highs on 30-year mortgage rates. And again, if you could get this down in the 6.5, sub 6% area, then I think that is beneficial from a single family standpoint.
Sure. And we're talking a lot about the Fed. Their tool to use here is overnight lending rates only. And now we're talking about 30-year mortgages.
Yeah.
I mean, you couldn't be further apart. and of course they're connected because they're all, loaning money out. But we can see something very different on the short end of the curve versus the long end of the curve. I mean, it's inverted as we speak. So why can't it be even more inverted as the year goes on?
Yeah, and again, this is, data that goes back to 1971, but you can put it in the books. 2022 is the largest net increase in interest rates on an annualized basis from start to finish since 1971. So you cover your big inflationary periods. So you were able to hold on, even though you pulled back from the highs, you still held on to these massive gains, which is impressive to say the least. And so, what does this mean for home buyers? Well, I think this is pretty self-explanatory, but here's your mortgage amounts, here's your interest rates, and you see the number of buyers that exist at 3% versus 8% and everything in between. So if we're 6.5 to 7%, you could see it's not a positive trend to create demand in home ownership, where you really need, if you can float, you can see incrementally what you create from a demand standpoint as you ratchet back down closer to 6%, as you get closer to 5.5%. This would bode well from a housing start standpoint. But, again, I think in trying to forecast, what housing looks like in 2023, really, and there's a lot of analysts out there. There was something in Yahoo Finance that, 27 of the leading housing analysts out there, and their projections were all over the map. But really, if you can get your crystal ball out and forecast where interest rates are, where you net out for 2023 goes a long way in figuring out if housing starts are a 1.3.5, 1.4, or closer to a 1.1, 1.2, or everything in between. I think really it's going to be a function of where 30-year mortgage rates are to create that single family demand.
This is a great chart, especially, when you're talking about housing starts. The difference between a 6.5% mortgage rate and a 5% mortgage rate is huge. That's a big number, really big number.
Yeah, no, I think, and again, when you look at a $200,000-$300,000 mortgage, with the cost of home ownership now, how many homes really exist at this threshold?
I'm looking at that the two lower bars.
I think the 400 and the 500 are more realistic.
Chicagoland, you're not going to find much to live in below 500,000.
Right. No, I agree. And so then, we talk about kind of interest rates, the Fed funds, and, so this is kind of when these two cross, they've been associated with not necessarily a change, but at least you could say that interest rates peaked when the Fed funds and 2-year rates cross. And that's something to watch right here, where you've got kind of the potential to see a cross. This is almost like an iron cross moving or something average, like that on the technical charts, where something to watch to suggest that maybe you can float lower once you reach that Fed funds peak, and that's forecasted for Q1 of this year. Maybe you do get the long end of the curve to start to pull back more dramatically. So we had jobs last week, and the one beneficiary, this is payroll jobs and residential construction. You can see that we've eclipsed, where we were pre-pandemic. So here's your pandemic start. You can see that construction jobs have broken out to the upside. You've created more construction jobs now versus where you were at the start of the pandemic. That's a positive.
This is really interesting.
Yeah.
This probably correlates with the housing completion numbers moving up so significantly.
Yeah, and again, the key here is retention of these workers, where you want the jobs to exist to be able to retain this workforce. Because when you look at payroll jobs, you're still, even though we've seen good gains in aggregate payroll jobs, you're still not back to pre-pandemic type levels yet. You're getting close, but you're not officially, you're kind of right back to, or you're kind of right back to where you should have been pre-pandemic. And so, I thought this was another good one. Share of population that is in the labor force employed. And, here's the start of the pandemic. Again, there's still a big void of people that were there that are no longer there. And we've talked about the rationale, the reasoning behind this. But the reality is, if the other kind of thing that the Fed is aggressively trying to limit is job creation here. This becomes an interesting metric to watch, in that and you can see this here. Here's job openings versus job hires. You still have a pretty big disconnect where you want to see these if the Fed is this is from U.S. Bureau of Labor Statistics, FRED, Federal Reserve of St. Louis. This is something that they're watching. They want to see this job openings come down substantially and narrow the gap here. This is another indicator that what their policy in play is actually working here. What they're trying to impact is working.
I'm going to throw my hat in the political ring a little bit here. It just blows me away when you see this chart. We need people in this country to take jobs. That's what we really need. And we battle over this border on the southern border. Like, why? We're a big, smart country. Why can't we figure out a way to get the people into the country and disseminate and distribute them so they can take these jobs?
I'll come back to these, but I think this is going to be the catalyst to see that play out, Mike.
You're probably right.
Look at personal savings. Okay, so here's your start of the pandemic right here. Here's all the free money. Look at, savings spikes, credit card loans go down substantially. Look at where you're at right now. You've broken out to the upside with credit card debt, and look at your savings historically at you're below where you were pre-pandemic. So as people run out of money, well, you're having to finance your lifestyle somehow, some way. And your savings are all-time low. So the hope is that this pushes people off the sidelines and back into the workforce. And so the other thing I wanted just to show, this is hourly wages, but it's beneficial for people to jump. You're going to get paid more on an hourly basis moving around than you are staying at a job. So this is kind of another reason why people are having a difficult time retaining at least hourly employees, where you're incentivized to jump jobs. You're going to make more jumping versus staying. And so then here's consumer CPI versus wage growth, and you can still see that your wage growth,
which one's
both
which?
are trending down, but cost of living is still greater than what your wages are. Okay. And again, this is what the Fed is looking to narrow with inflation. They want to see this red line come back under the blue line. That's another positive metric that what they're doing is working. So I thought we'll kind of jump into housing now. So it costs roughly $4,400 more a month to own a home than to rent an apartment of Orange County, compared to just $600 more a month in a market like Indianapolis. So obviously we know that higher paying jobs probably exist in some of these markets for obvious reasons, but cost of ownership versus renting has gone parabolic here. I mean, this is just insane. Look at the increase in San Francisco, San Jose, versus even a market like yours, like Chicago. The dream of home ownership has really gotten away in some of these markets here, where, again, the shift from single family to multifamily. Here's another metric that bores that out. So this is another thing. You don't fight the Fed. So the Fed's metric for inflation is about 2.5% to 3%. Okay, Federal Reserve Bank of New York. This is their data. Median 1 year ahead expectation. So this is December of 2022. Over the next year, they expect inflation to still run at 5%. Their goal is 3%. to think that they're going to pivot off of this, they need to see the data, the metrics to support this, because their own forecast is 2.5 to 3%, and they don't think they're going to get there for another 3 years.
Yeah, it's a long slog.
So here's sorry, fat finger. So here's a forecast of home sales forecast. You can see National. This is NAR, National Association of Realtors, thinks we bottom out into Q1 and then start to build up from there.
And is this existing home sales?
This is new and existing.
Oh, I'm sorry. Right in front of me. Okay.
Yeah, no. I had a look too. And then here's your more, and again, it coincides with, one supports the other. So you start to see better returns as interest rates start to trend lower.
Gotcha.
Case-Shiller, this is pretty interesting. So this is kind of peak changes. So these are the highs in 2022 and where each of these markets are. So this is peak change and closed sales. So this is sales, how much sales are off in each of these cities from the peak in 2022.
Interesting. Okay.
And then this is John Burns. These are your growth areas. So normal markets, no surprise, Florida, the Carolinas, I guess kind of here's your Indianapolis, where again, it only costs $600 more to rent than to own. And then you look at the red areas, these are the slow areas. So I think when you try to forecast where housing growth could be geographically in the U.S. in 2023, you're going to have to fixate on certain areas here.
Well, you want to be east of the Mississippi River.
Yeah. And you hope that, really you look at Phoenix, Tucson, or really the Phoenix area, you look at Dallas, you hope that these turn orange to yellow and you start to get some of that growth back into those key consuming areas. Last one before we jump into lumber, I thought this was really good. So where's all the organic growth in logs and lumber? Again, I wish this included Canada, but here's your Pacific Northwest, and then look at down south. Southern yellow pine is your predominant species for the foreseeable future.
So this is
where all your logs are.
This is showing where logs are being harvested currently.
Yep.
Wow. Yeah.
I hope the CME's watching. Ding, ding, ding. Southern yellow pine contract. Here you go. And so as we'll jump into lumber now, obviously we're up today. If I had to wager a guess, it looks like algo or fund type buying today, blowing up that Jan-March spread. Jan-March traded out to negative 55. So January can't get out of its own way.
Today's a tale of two markets.
Yeah.
We have the January contract, which is essentially it's a cash contract right now because it expires on Friday. And now we have the March contract, which is as long dated of a front contract as you will find in the timeline of how trading goes. So yeah, there's some expectations of better pricing than the current cash market, in coming into the end of Q1. But boy, I tell you, that January contract just is flat.
Well, and again, you see January, the low so far is 340, 240. The reality is, Mike, that's still a premium to where physical cash is. I think print tonight is likely to be down again. Print last week was 335, and I think most people thought that was generous to where you're probably going to be sub 330, sub 325. Now, you could make the case that the markets are bottoming. You're certainly attempting a bottom in 6-inch. You probably have seen a bottom in studs, but bottom to do what? And to put this into historical perspective, again, March 2020 expiration was 322.30. So January has a legitimate chance of being back to a legitimate pre-pandemic or the onset of the pandemic type low, where, again, the only thing that stands out here is lower lows from an expiration standpoint. At some point you will reach some kind of area where you'll see more production come off. But to say that we've done it, I don't think there's anything to suggest we've done anything just yet. And so here's a weekly continuation. In an ideal world, you bounce out of here. And so then the $1 million question is, okay, we know that March today is $396. January got down to 42.40. Let's say that Jan settles at 350 or 330. Where does March belong relative to January expiration? How big of a gap does March, legitimately, what kind of cost to carry does March deserve if January and physical cash are legitimately at 330, 335 or lower? There's numbers out there in both the East and West on 4-inch sub $300 now. So this is the difficulty when you look at March. Again, if print, even at, let's just say print's unchanged at 335, 10% of that, do you deserve to be at this kind of basis in March? And that's the difficult question. We know that the funds are short, the funds could short cover, but from a basis standpoint at $335 lumber, historically, that kind of basis doesn't make any sense.
It's
and
juicy.
And so here's, a monthly continuation. And okay, I know you can't do this, but throw out the last 2 years. Here since 2006, 2007, look where lumber fluctuated, basically in this, as low as the 250, 275 area. You had the 2018 spike up to 659. But if you just drew a straight line, you could make the case that lumber belongs somewhere in this 350 to 360 area. And where are we today? January's right there.
Yep. I mean, from a perspective of what the industry looks like from a supply side, we're not that different from 2018 than we are today.
No, and unfortunately, from a demand standpoint, you're probably not all that much different either. And so here's Jan daily. Here's a March daily. Obviously, March is making the case for a double bottom here in the 62.60 area. And this was as of this morning. March has spiked up to $400, so you're up into the Bollinger Band high. This is the 44-day moving average. So do you break out through the Bollinger Band high here at $400? If you could do something like that, then the next target would be this 420, 425 area. And then above there, you jump all the way up into the 100-day of 450, 460. So technically speaking, if you do get a commodity fund short covering, then technically, yeah, you could justify a run of $450 to $460 in March. But that being said, you better trigger something more substantial in cash to justify this. If you're not going to ignite cash, then this is going to be a big run to the upside. That's supply constraint driven in the form of the commodity funds. And at the end of this, the fundamentals better bump up to support this in physical cash, or you're going to come collapsing right back down. And then here's your Jan March spread. And again, this doesn't even reflect, this traded at 55 under. So here's your commodity funds rolling their shorts from Jan to March. They started right in this 5 over area. And here's your ultimate bear market structure spread, where you went from 5 over because of the commodity funds. And once the funds started to move out of January, again, they started to short cover their Jans and buy Jan, sell March. You just collapse this spread. So if anybody kind of, again, January outright doesn't make a lot of sense, but from a spread standpoint, you could do a Jan March right now at negative 46.90 if you wanted to.
That's a pretty great basis right out of the gate.
Yeah. For $350 wood, that's one hell of a basis. And so here's March, May. Again, the expectation as the funds have rolled from Jan into March, that this spread ultimately, just like this spread, went from 15, 20 under all the way to 5 over. you probably see something similar develop over the next 4 to 6 weeks, where March, May, okay, if the funds short cover, that's even better. The hope is that they roll into May, and you get, again, just by virtue of them rolling, this takes you out to that 3 to 5 to 10 over area. So that's kind of the expectation with the funds in this market. Watch the spreads, because there's a lot of good information to take out of the spreads with the funds there. So here's historical January lumber contract closes. Again, we're $350 last right now. Throw out the last 2 years, and you're right in the sweet spot of where you belong.
You take out those last 2 years, and it looks very normal.
Yeah, absolutely. And then, this is a seasonal chart that shows current lumber, CME lumber prices versus a 3-year and 5-year. And we've gotten conditioned to think that the last 3 years, heavily skewed by the previous 2 years, have influenced a higher reset of prices. We deserve to carry some kind of premium given the last 2 years versus 2019, 2018, and beyond. And so we've had this big divergence over the last 3 to 5 years versus where we are today. But this is something that Alex and I did today. If you take out the last 2 years, so here's the seasonality without 2021, 2022, you're basically right back in the middle of where you belong.
I mean, there's a light seasonal uptrend here.
Yeah, no, absolutely. But again, if do you belong? Okay, so maybe you belong at 400. You can make that case. Maybe you belong at 450. You get the seasonality play into the end of January, the middle of February. And again, anticipation of those spring needs. So that's kind of the upside potential of this market. But why do you have to trade substantially higher? There better be a pretty good reason to be above $500 a thousand in this market.
Shameless plug for the Thursday show with Matt Lehman, but that's one of the things he looks at with his analysis is throw out absolute prices and let's just look at the trend over the last 20 years and what happens. And maybe we're just delayed a little bit on this inventory build, because I feel like the cash market has been in inventory liquidation mode since last spring, really. I don't know anyone that said, "Oh, I have a yard full of lumber and I'm happy."
Well, and again, when I think the reality is when you look at this move from 650 on down, and then you're just in this slog, have the big national buyers truly just gone away, or have they been in accumulation mode all the way down? And as the takeaway is slowed, whether it's seasonally or economically, where do inventory stand? I think wholesale inventories are probably leaner, but I think that's the $1 million question with end user inventories, with retail inventories. Are they legitimately at the low water mark versus seasonally where they should be? Or have you had this bigger accumulation all the way down? The mills have to go somewhere with their wood, and we've yet to find any stability. So where, if you ask the sawmills, they'll genuinely say that the seasonal buy is just around the corner. But we've been hearing that from 550 down to 500, from 500 down to 400. We've been hearing that all the way down. So I think that's the again. And for me, Mike, it's okay. Go back to the March chart. Okay, you get the fund short covering, you get a seasonal round of buying, you're up at 400, you go to 450. Do you fundamentally belong here? Is there fundamental justification in the form of demand to ultimately support a higher reset at $450? I don't know the answer to that. I think that's what we're all searching for.
What I see us setting up for here is just phenomenal basis trade opportunities.
Yeah.
And it's, to me, 2023 is going to be the year of bunt singles and run it out grounders, right?
That's my analogy for at least the first quarter to first half of 2023. You can go to the Hall of Fame hitting singles and doubles.
I mean, think about this. If you, like today, you locked in a $50 basis,
Yeah.
between now and March. Sorry, you're not going to have the margins you've had in previous years, but you got a margin.
Well, and again, like this is this doesn't even reflect March. This is March's close as of yesterday. So this is up another $17. So you have a 50 to 60 plus dollar basis opportunity. And that's based upon print of 335, where if print is lower tonight, contractually, you're going to have people that own wood sub 335 on a lower print. So again, my question is for the industry is at $335, what's the likely margin scenario on that physical cash? If you're just going to trade that cash, historically, what's the margin opportunity there? Is it 5%, 6%, 8%? And I'm genuinely asking this question. If I can put the wood on the ground, and this is the key to being a basis trader, I'm not back to backing this. I'm not waiting. I'm not trying to liquidate one side as it's rolling against me. If you can put the wood on the ground and buy wood legitimately at 335 or cheaper and sell March right now at 396 from a basis opportunity, from a profit margin opportunity, that 6 to 8% margin is conservatively 15 to 20%. Even if I'm just going to capture 80% of that basis, do you legitimately think that buying cash at these levels, again, historically speaking, at $335 lumber, what's the historical profit margin on that wood versus the opportunity to basis trade? Where again, beauty's all in the eye of the beholder. And look, March might be the greatest buy in the world at sub $400 because we're going to go to 450, we're going to go to 500, we're going to go to 550. But to me, that's the best case scenario from a basis standpoint, that this is all a bad dream, that futures is going to go against me from a basis standpoint, because ultimately, if March is wrong here in selling, then that means your physical cash, which you probably have a lot more than whatever your basis trading, is going to appreciate all that more to narrow this basis to come back into that historical basis. And again, when you look at the basis opportunity in a bear market, your historical basis should be around $15 to $20 a thousand. So if you could capture 50, if you could capture a basis of $50 to $70 with $335 lumber, that's a pretty good opportunity. And I understand what we've come out of the last 2 years, where, well, no, I want a 70, I want 100, I want $150 basis. Those basis opportunities, Mike, exist at $1,000, at $1,100 lumber. You're at $350, $330 on physical cash. I think you have to rein in the expectations and go back to, it's okay to hit singles and the occasional double in 2023, or at least to start the year.
All right, I got one thing I want to show, which I thought was kind of interesting. I read today. Let me share my screen. So this is softwood lumber imports into the U.S. Slightly weaker in 2022 than 2021, which makes sense because at the end of the year, things weakened up a bit. But what I found really interesting, one country made up all the loss. I guess others here, but basically Canada. We imported I think it's cubic meters of wood, almost 1.7 million less cubes. And look at these other countries that had the big jumps, Germany and Sweden, Romania. I mean, even Chile. Latvia, obviously huge, but it's a small number. But we've been hearing about Canada having less wood come to the United States for a long time. And I was a little bit of a disbeliever of it, but I think it's reality. What does this mean for you as a lumber buyer or someone involved in the lumber market? You may need to look outside your current relationships for product. The ports are full of a bunch of really good wood. It may be a little different than you're used to. It might be having some different design values or something. But man, I tell you, I would open up my field of vision and look at some other stuff.
Yeah, no, I think we said that at the high end, where it's okay to look at different species and items, and I think the same holds true even at the perceived low end of a move here, where it's okay to look at other species, specifically Euro, and that definitely is out there in the east, up and down the East Coast, around Florida into Texas. You definitely have a lot of Euro, and my understanding with Euro, and again, I'm open to anybody that's got any thoughts or feelings, is that this is the market for Euro, where Europe is completely DOA, and that the only market really for European wood right now is into the Middle East, and that's all predicated on oil and energy. And you need the barometer there is Brent crude oil at 85, really 80 to $85. That's the green light to organically grow demand into the Middle East. But outside of that, not necessarily from a return standpoint, but just from a churn standpoint, this is still the most desirable market for Europeans, because you might not like the number or the returns. So you're either going to shut down, and you have seen curtailments in Europe, or you're just happy that you can actually churn wood into the United States, which you're having a very difficult time staying in your own neck of the woods in Europe right now. That business just has kind of gotten annihilated here. So you can see the curve, and here's the legacy versus the mini. And in a reminder, again, May is the last legacy contract, whether you like it or not. Come May 15th, this no longer exists. It's 100% this. And so when we look at open interest, we continue to build open interest. We're up over 3,200 in the legacy contract, which is awesome. And then when you look at the mini, we're still hanging above this 300 watermark. And as you grind through March, again, you're going to see a transfer of this, where I would expect by the time you get into March expiration, this is going to be a lot closer, if not actually seeing this be greater than the legacy contract here into March expiration. And then from an open interest, or from a CFTC standpoint, Mike, again, managed money, the commodity fund shorts are still holding a massive short position. Commercially, almost non-existent. So this will be interesting to see with this spike up in March. Do you get basis traders? And for the sawmills, this is a phenomenal opportunity for mills to put their wood into reloads and just sit on the wood, sell the March against it, and take the wood off the market and legitimately build out order file, and hope that's, again, selling March is completely wrong, but at least you clean up some of the misery on the physical cash side, and just put it into reloads and sit on it. It's sold. You've sold it at $395 plus. Take the wood off the market and legitimately build out order file here.
All right, we we got a long one going here today. Let's wrap this up. I've been thinking about the show, earlier this week, and what I came up with is, right now is a time where it doesn't look like you really want to do risk management, because nothing's going on. Everybody wanted to talk about risk management when the market was at $1,500, right? Well, the barn cats, or the dogs out of the pen. I mean, the cows out of the barn, horses out of the barn by that point. Now's the time to think about risk management. It doesn't look pretty, but if some black swan event happened and prices blew up, you'd be very happy that you hedged some of your exposure long, or short.
No, absolutely. And I think from a forward standpoint, and I know we're talking about a basis here, but home builders, end users, that, legitimately, look, I can only buy so much cash, and look, cash is no longer free here. You can only tie up so much physical cash now. So, on these pullbacks in futures, as you narrow that basis, then the forward opportunity still exists, especially for those that need coverage. Because again, at the end of the day, March is, like you said earlier, Mike, a tale of two cities. March is not a reflection of today. The reality is March is April 1st to April, the third week of April delivery. That's that time frame that March is trying to kind of formulate where March, where that wood belongs at that point in time. January is obviously today. March is another point off in the future, not today. So that's the other kind of understanding each of these contract months and what they represent to the buyer and seller.
This is interesting. You got price of eggs. What's going on?
Yeah, I saw this on LinkedIn, and I thought this was pretty. Somebody inflation in the new Bitcoin, where look at egg price. It's $3.50 versus $1.50. So I don't know if there are less chickens or what's going on here.
Hey, here's the reality. December 31st, I was in Eagle River, Wisconsin, stopped at the grocery store to pick up eggs for breakfast the next morning. I couldn't find any in the grocery store. I thought maybe they moved them or something. They were flat out of eggs. Never, first time in my life I've ever been to a grocery store that did not have eggs.
It's funny you mentioned that, and my wife, again, I think this was before Christmas, went to our normal grocery store. They didn't have any eggs either, which is the most bizarre. Like, how do you not have eggs? Like what is there this big run, or how do you? So this explains why there must be less chickens out there.
Yeah, it's time to buy some chickens and a windmill and get an electric car.
Buy chickens and short eggs. There you go.
All right. Thanks, Greg. Sorry, everyone, that we went so long, but we had a lot to cover.
Yeah, we're officially caught up, and we'll have kind of more of a normalized show next week.
All right. Sounds good, everyone. Take care.
Thanks, everybody. Thanks, Mike. Take care.